Okay, great. Thank you very much, everybody, for joining us today. It's 10 o'clock, so we'll make a start. Just the usual reminders. Can you please keep yourself on mute when you're not talking, as that helps to deal with the reducing any possible sound interference. Also, if you want to say something, please go onto the chat bar and type in RTS. And then hopefully we'll be able to control easily who can be seen and make sure everyone speaks. For the record, those who may remember, the chat bar is part of the recording of this meeting and would be subject to being reported in any freedom of information request or anything like that. So please do bear that in mind when you write comments on there, that it needs to be appropriate because it is a public record. Right, on to agenda item 1, any apologies?
We've not received any apologies, Chair.
Okay. Any declarations of interest? I've seen there's no declarations of interest. Yes? Oh, blimey. Can you hear me?
We've not received any declarations of interest, Chair.
Thank you very much. Moving on to the minutes of the last meeting. Are there any factual inaccuracies that need to be pointed out? In which case, we'll assume that they're a true and accurate record, and I will sign them in due course. Are there any other points that anyone wants to raise from the minutes that aren't covered anywhere else on the agenda? Peter.
Thank you, Chairman. In the minutes, it says that the annual report is to be approved by yourself and myself. I've not seen anything yet. Can I just ask as to the progress of the annual report, please?
David?
Yes, we're still waiting for the independent auditor's report. So at the last meeting, excuse me, in November, the committee approved the annual report subject to us receiving that final independent auditor's report.
We will be mentioning this later on in the agenda.
Okay, thank you, Chair.
Anything else on the minutes? No, in which case we'll go on to public participation. We've had a total of 4 questions, I believe. 3 from members of the public and 1 from Councillor Clayton from Dorset Council. I propose that we'll deal with the 3 from the members of the public first. The procedure is basically that the officers will read out the question and then I will read out the answer. And that's the situation for the 3 public ones, which we'll deal with first. So, David, if you want to start with the first question, please. David, you're on mute.
Sorry, Chairman, I thought you were going to read out a preamble prior to that.
You are correct. Now, where have I put it?
Just for the benefit of
you are
other
quite
members.
correct. Yes,
Thank you.
I just wanted to point out that we received a number of questions this time from members of the public. And also, to be honest, we've had emails in between meetings as well, asking questions about our position concerning the pension fund and its investment in fossil fuels. Of course, we will answer each of the questions in turn, but before we do so, I'd like to remind everyone that this topic was discussed at length at our meeting in September, and that the reports, minutes, and a recording of those discussions are all available on the Council's website. So anybody can go and hear what we discussed and read the information we were debating about.
Is now joining.
And join accordingly. I'd also like to remind everyone that the purpose of the pension fund is to pay benefits to scheme members, and the committee has a duty to scheme members and their employers to ensure that their contributions of the fund are invested appropriately to make returns sufficient to meet those obligations. This duty overrides any other considerations. So I thought I just wanted to clarify that situation and then on to the first questions. David.
Thank you, Chair. first two questions are from Daryl Minards on behalf of Southwest Action on Pensions. First question, Councillor Beasley stated that he was confident Dorset/BCP had a measurable set of goals for decarbonisation versus divestment. Given this confidence, will this now be included in each council's climate emergency plan on carbon neutrality as part of your climate emergency declaration? And if not, why not, given the carbon footprint of the pension plan as a part of Dorset BCP's impact?
Okay. Our answer is responsibility for all matters relating to the administration of the local government pension scheme in Dorset is delegated to the Pension Fund Committee, which comprises 5 Dorset Council councillors, 3 BCP council councillors, and 1 scheme member representative nominated by the trade unions. Whilst the committee are fully supportive of the climate and ecological emergency declarations by a number of scheme employers, including Dorset Council and BCP, we believe that it is more informative to consider the carbon emissions consequences of the pension fund's investments separately from those of its scheme employers. On to question 2.
Question 2. Secondly, it's been stated by Councillor Beasley and also Drew Mello that the strategy is to influence the fossil fuel companies towards decarbonisation. Exactly what specific steps has this committee taken, either via voting in shareholder meetings or raising questions at shareholder meetings in the 6 months since the September meeting? Please provide the specific meeting details as a matter of record.
And our answer, as part of the government's requirement for LGPS funds to pool investments, the Dorset County Pension Fund no longer holds direct investments in companies. Instead, the vast majority of its equity investments are now in pooled investment vehicles managed by the Brunel Pension Partnership, the LGPS investment pooling manager set up and fully owned by the administrating authorities of 10 LGPS funds, including Dorset. All voting and engagement with companies is now undertaken by Brunel on behalf of the 10 shareholder funds. Brunel's website documents its stewardship policy and voting guidelines, as well as its voting and company engagement records. That can be found at www.brunelpensionspartnership.org/stewardship. Dorset County Pension Fund is also a member of the Local Authority Pension Fund Forum, which represents the majority of LGPS funds and LGPS investment pooling managers. LAPPFF engages with hundreds of companies every year to promote the highest standards of corporate governance and responsibility, including aligning their business models with the Paris Climate Agreement. Full details of the work of the LAPPFF, including its quarterly company engagement reports, can be found on its website, which is also on the paper. On to our third question.
So we have a question from Julianne Booker on behalf of Dorset Action on Pensions. We know that to stop catastrophic climate change, we have to keep fossil fuels in the ground and transition quickly towards a clean, renewable economy. The fossil fuel industry has spent decades spreading lies about the climate to protect their profits at the expense of people and planet. It's imperative that all councils and pension funds break ties with this morally bankrupt sector and divest from fossil fuels. By doing so, they can take necessary action to protect fund members' pensions from risky investments and take a stand against an industry which is causing climate chaos and endangering our future and the future of our children and grandchildren. Dorset Council Pension Committee has chosen an investment strategy of decarbonisation rather than divestment. A growing number of people in Dorset understand that continued investment in fossil fuels is bad for our planet, bad for our health, bad for our future, and bad for our bank accounts. They are seriously questioning why Dorset Pension Fund Committee continue to put money into fossil fuel companies. Dorset Action have now launched a campaign calling on Dorset Council to totally divest from fossil fuels. Information on the campaign can be found on the Dorset Action website dtaction.co.uk. Amongst other things, the campaign asked people to write to the Dorset Pension Fund Committee chair and explain why they want the committee to stop funding fossil fuel companies and to copy their letter to the Brunel Partnership. On 15th of November 2020, Dorset Council provided, following a Freedom of Information request, a report showing the current investments in highly polluting companies, such as Canadian Natural Resources, which is an oil tar sands company, Since September 2020, which of the companies listed in your report have you now removed from your direct investment list?
Our answer is that Dorset County Pension Fund no longer owns any of the direct investments you have listed. Okay, those are the three questions from members of the public, and they've been dealt with according to our standing orders. We also have a question from Councillor Clayton from Dorset Council. Members of the councils have a slightly different procedure to their questions compared to members of the public. For this, Councillor Clayton can read out his own question. I will provide an answer, and then Councillor Clayton may provide a supplementary question based on the answer that I've given. Councillor Clayton.
Yeah, thank you, Chair. And first of all, if I could perhaps give an apology. There's a certain amount of duplication in this. I accept that. And my confession, had I done my homework, I may have phrased the question differently, but nevertheless, I'll read the question as I originally wrote it. No one seriously doubts the contribution the fossil fuel industry has made to a potentially catastrophic rise in global temperature. As a result, many people now regard investment in this industry as not only unethical, but because its days are numbered, as financially unsound. Nationally, 6 local councils, 86 universities and the UK's biggest pension fund, Nest, have all committed to divest from the fossil fuel industry. Last September, this fund committee agreed a new decarbonisation strategy. According to the chair of this committee, these changes will deliver significant reductions in our carbon footprint. Question: will these significant reductions include an actual end to all fossil fuel investments? If yes, by what date? If no, how do you justify any continued investment?
Okay, my answer is this topic was discussed in some detail at the meeting of the committee in September 2020. And as I mentioned before, the reports, minutes and recording of the discussions are available online on Dorset Council's website. The approach agreed by the committee then does not include a commitment to divest completely from companies involved in the sourcing and refining of fossil fuels. Instead, it seeks to reduce investment in all high carbon emitting companies and to influence the demand for fossil fuels and their financing, not just their supply. The decision was based upon evidence presented to the committee by independent investment consultants Mercer that a strategy of decarbonisation can deliver significantly greater reductions in the carbon footprint of investments than can be achieved by divestment. Divestment also removes the opportunity to influence companies by working with them to transition to a lower carbon future. Targeted divestment remains an option from individual companies who will not positively engage. Significant decarbonisation will be achieved through the transition of assets to the management of Brunel Partnership, the pension fund's LGPS investment pooling manager. 10% of the pension fund's assets are now invested in Brunel's Sustainable Equities Fund. I should explain that it's also 20% of the total we have invested in equities, and it's our largest single investment fund at the present time. All of Brunel's other funds are, all our other invested funds with Brunel are based on a policy of being committed to a 7% year-on-year reduction in their carbon footprint. In 2022, Brunel will be undertaking a stocktake of their approach to engagement and divestment. If this review concludes that companies are not taking appropriate action and sufficient steps to manage climate risks and to enable alignment with the Paris Climate Agreement, then the Pension Fund Committee will need to reconsider its approach as well. Okay, that's the answer of my answer. So,
yeah, if I could just quickly come back, Chair. Reading through the minutes, I'm inclined to ask why the investment consultants Mercer only considered 2 potential approaches. Why just 2 approaches? Are these 2 options mutually exclusive? And why can't a way be found to divest and have ethical decarbonisation investment?
Mercer's made quite clear in their presentation why they were suggesting the alternatives. What they were doing was comparing what other funds have done, and particularly, I believe, the Church of England Fund, and the policies that they have been following, and they compared it with a policy that they were recommending, which was decarbonisation. It seems to us, based on the evidence presented to us, that the more effective approach towards reducing carbon footprint was to go down the one recommended by Mercer's of decarbonisation. The problem with the other approach, which it sounds more as though it should be effective, but the actual detail of how it puts it into practice doesn't work as well. What it does is take sectors of the stock market, for example, coal producing or oil producing, and removes all the investments from those particular sectors. But it doesn't necessarily affect other companies that have a very damaging effect on the environment, but do not belong in that same sector. For example, the example that Mercer's quoted was, what do you do about airlines? They obviously use up a lot of fossil fuel emissions. And I'm sure some people would argue they should be banned, but they don't belong in a sector necessarily that other people have banned in the past. So we're basically in a position of following the advice as provided by our technical experts. We listened to that advice. We had the debate, and that's the reason why we came to the decisions we came to. I'm sure it will be reviewed again in the future, and other advice can be sought from that updates the position at that time. Okay, so that's my answer to that question. Thank you very much, Kelvin. You're welcome to stay for the rest of the meeting.
Thank you, Chair.
Okay. Moving on then to urgent items. I'm not aware of any urgent items. David, do we have any?
Items have been raised, Chair.
Okay. Then we'll move on to item 6, which is the Pensions Administration report from Karen Gibson. Karen, over to you.
Good morning, everybody. Okay, so hopefully you've all got the administration report, and I'll briefly run through that. And obviously, please do feel free to ask any questions on that. The key performance indicators are reported there, and you'll see that the main key performance indicators that we report on are all looking fine. The team is still working at home, which is not ideal. And as mentioned there are some areas of work that we have been affected, but the key areas we've all kept on top of and are doing very well. Item 12 on there is the systems implementation. You'll be aware that we're changing our system, which is very significant change for the pension fund, and there's a huge amount of work going on for staff, which is literally every day there is something going on. The new system itself will go live in July. There's lots of monitoring going on, including the project board, and there's 2 members of the local pension board sitting on that board as well. So things are going, at the moment, they are going well. And if anybody wants to have a look at any of the key documents, the highlight report or the RAID log, you are most welcome to have a look at those. And you'll see there the things that have been completed at the moment. Training, the system is being built at the moment, and things are currently going well, I'm pleased to report. You may be aware, section item 13 there is the revocation of the public sector exit payments, and you'll probably be aware of this. A couple of important things to note here. Firstly, the Dorset County Pension Fund didn't have anybody who was caught in that interim period where the exit cap regulations came into place before they were revoked. So we're not in the position that some funds are in, where we're having to implement a remedy for people that were affected by those regulations, nor did we implement early the new strain factors, which some authorities did. So there's quite a lot of authorities around the country having to sort out some difficult situations. So we're not in that situation. The other important bit of information here is to note that this is sort of not gone away. The government are, very determined to bring this in, and we've heard that they will be bringing it in possibly later in the year. What we do know is that there will be a further consultation on this, so that we will know when it's coming in. I do understand that the government are still quite determined to bring it in a very similar format, so they're trying to find ways to do that, possibly with complex cut-offs and mixed benefits, but there will be better lead-in times, etc. The judicial review has not been cancelled, so it'll be interesting to see what happens there. We're obviously keeping employers informed. It's really important that employers looking at workplace reforms are aware that whilst this is not here at the moment, looking ahead, it will come back again. So I'll obviously keep you informed of any developments as they come along.
Okay.
Item 14, just to keep you updated on McCloud. At the moment, we are focusing on the data collection from employers, and that is ongoing, and there will be a mixed picture. And I think with our larger employers, we are likely to get the data in okay. In the main, we won't be loading it onto our systems until at least the end of the year because of the change to the new system. And we've engaged with our new system supplier to ensure that they have the necessary tools to enable us to get that data on. So that project is ongoing, and there will be consultations in terms of the regulations to enable us to implement the McCloud remedy going forward. Item 15 is the good governance report that has been published. You'll be aware of this. I think this has been, I've mentioned this to you before. So on the 15th of February, the Scheme Advisory Board published their Good Governance Phase 3 report. The Phase 3 report provides further details on some of the recommendations that were included in the Phase 2 report. And these are all available on the Scheme Advisory Board website. These two reports are best read in conjunction. So the Phase 3 report provides further detail on the following recommendation, amongst others, that there should be an LGPS senior officer, a single named officer responsible for the delivery of the LGPS activity for the fund. A conflicts of interest, looking at publishing a conflicts of interest policy that is specific to the LGPS. Details of representation, so each administering authority must publish a policy on how scheme members and non-administering authority employees are represented on its committees. Skills and training introduce a requirement for key individuals, such as pension committee members and Section 151 officers, to have the appropriate level of knowledge and understanding to carry out their duties efficiently. You may be aware that there is a requirement for the local pension board members to have knowledge and understanding of the LGPS, and that's not currently there for committee members, although it may be there. It's not actually detailed as a requirement. So that's widening the requirement there. Service delivery regulation change to make it compulsory for administering authority to publish an administration strategy, which Dorset County Pension Fund does. It's in the regulations, but not a requirement. Those key performance indicators that focus on ensuring each administering authority has defined service standards. So there might be some uniformity there and has governance in place to monitor those standards. And business planning processes, so the senior officer and committee must be satisfied with the resource and budget allocated to administer the LGPS each year, and required expenditure should be based on the business plan for the coming year, not the budget for the previous year with an inflationary increase. So that's the good governance report. That's obviously quite significant to us, and we will be waiting for MHCLG to come back with recommendations. There may well be guidance and maybe legislation. So we're just waiting to hear a little bit more now in regard to that. I've also mentioned here that HM Treasury has a consultation on implementing the increase in the normal minimum pension age, and you'll probably be aware that the current normal minimum pension age is 55, and the government has for a while now made it clear its intention to increase this to age 57. So this is not a consultation that is specific to the LGPS, but it will be a case. It does seem to to be suggested that it will be a case that there will be protections coming into each individual scheme. So it's quite likely, I'm wondering, that there will be a change for new members into this scheme, meaning that there will be an added layer of complexity, as there always is in the LGPS, where some members have benefits under one scheme and some under another. So that change will come in a little bit later. So that change will happen the 6th of April 2028, and we'll have to have changes to the LGPS scheme. Just to let you know as well, the Pension Schemes Act 2021 came in, received royal assent on the 11th of February 2021. A lot of this wasn't necessarily specific to the LGPS, but areas that were specific to the LGPS were the climate risk reporting. Now, the scope of these regulations does not include the LGPS. However, regulations are expected from MHCLG to mirror these requirements. So that may well be of interest to you. And in addition, there is the pensions dashboard that's relevant to all pension schemes, of course, and that's something that the LGPS is working towards. We've probably mentioned that before, but for those of you not familiar with the pensions dashboard, this is an initiative of the government, and I think it's a good initiative where there'll be one central dashboard that anybody in the country can go to have a look at all of their pension scheme entitlements in one place. So that will include the state pension. And from our point of view, I think it's very good because we actually do have a lot of small pensions that we cannot trace and we cannot pay. So once this is embedded in the future and people are familiar with it, I think it will have a very useful role. And we will probably be uploading information to it similar to the information we provide on an annual benefit illustration. So that work is ongoing with software providers. There's also work on transfers out, and we're waiting for further details on this. There's a lot of focus generally on transfers out, particularly on scams at the moment. So we're waiting for more details on that. Another further point of interest is an update on the cost control mechanism. You'll probably remember that after the 2016 valuation, there was the cost control mechanism, which actually looked at the new scheme and looked to see whether the costs of the LGPS nationally stayed within a cost envelope. And essentially, if the scheme costs went above a certain level or below a certain level, then the sort of essential elements of the scheme would change. Now, initially, the outcome of this cost control mechanism looked to that the outcome was that the cost of the scheme had reached the floor, and therefore the scheme was to change to become more generous. However, very soon after, only a few months after this was becoming apparent, McLeod came along and the cost control changes were put on pause because of McLeod, because obviously the effect of McLeod is to increase liabilities on the scheme. So everything has been on pause since then. So there's now been some movement in regard to this, and the cost control element of the 2016 valuation will now be completed, has been decided on the deferred choice underpin, and this will establish the cost of implementing the McLeod remedy. And it has been decided that there will be no reduction to members' benefits as a result of completing the 2016 valuation if the cost ceiling is breached. But if the floor is breached, this will be honoured by implementing increases in benefit accrual and/or reductions in member contributions from the 1st of April 2019. Any change in employer contributions in the unfunded schemes triggered by the 2020 valuations will take effect from 2024 instead of 2023. So that's the unfunded schemes, that's not the LGPS. So the Scheme Advisory Board has confirmed that discussions on the board's own cost management arrangements for the LGPS in England and Wales will remain paused until HMT publishes its final version of the directions to be used for the 2016 valuation. I understand as well that there's likely to be changes to the cost cap mechanism itself. I think there has been a view that it didn't necessarily work too well first time round, and they didn't necessarily expect to see a trigger at the first valuation. So it may well be that there will be some changes to that. The 2020 cost cap review will hopefully start later in the summer, and we'll have to wait and see the outcome of that. There has, of course, been, it will be interesting to see how they address the fact that since the first 2016 valuation has happened, not only has McCloud come along, but obviously there's been a lot of change to financial markets and, of course, the pandemic. So there's going to be directions on how to deal with that. So that's a brief run through of the administration report. Does anybody have any questions on that or any other matter?
Before we start that, Karen, I just wanted to say what a huge thank you to you and the members of all your team dealing with what has been a very difficult year, obviously for everybody. And you've kept on top of the game and made sure that all the things that needed to be done have been done on time, and the KPIs show a very impressive track record of keeping things on afloat and keeping them going. So I'd like to say a big thank you on behalf of the whole committee for all the work that you've all done. So thank you very much.
Thank you, Andy.
On to questions. Peter first. No, sorry, John's first. Sorry.
Thank you very much, Chairman. And if I could echo the comments that you've just made, because I fully appreciate the huge amount of additional work that Karen and her team have undertaken. And that is not at an end. It's an ongoing mountain of work. And I think one of the concerns I've always had is that we make sure that Karen and her team are adequately resourced to take this on. Because I'm not sure how well known it is that the number of issues that are coming towards us at the moment really are greater than they've ever been, and without the additional resources will be unsustainable. I was just going to make a quick couple of comments, if I may, Chairman,
Sure.
Mainly from the perspective of being one of 4 councillors who are members of the Scheme Advisory Board at the LGA. We have an opportunity there to feed in information, actually, and I would always welcome from Karen and her team more questions and more issues on the front line that need to be raised through the Scheme Advisory Board. I'm in a very fortunate position to be able to do that at a national level, and I'd be very happy to take some of them forward. And I suspect, Chairman, that some of them that have been mentioned this morning are going to grow in scale and in number over the coming months and indeed the next couple of years. Just specifically on the points that Karen has raised, the issue of the exit cap is exercising many people in the LGPS, and the fact that the government have withdrawn the proposals at this stage means, as she has rightly said, that there is going to be another proposal coming forward, but the judicial review process is quite likely to continue in parallel alongside that. And consequent to that, there will be no doubt further appeals. So it's going to become a very complex situation. I won't be critical in this meeting of the way it's been handled, but it is putting a lot of pressure on people who are on the front line, I have to say, but I'm pleased to see that it hasn't affected any individual members of our scheme. The second point, Chairman, is with regard to
is now exiting.
Is with regard to McCloud and the issue of data collection. We shouldn't underestimate the work that Karen and her team are having to do as a result of McCloud. And again, that's not just complex, but it is ongoing as well. And I suppose the third and final area is over good governance phase 3. And it's in those sort of issues where I really would welcome any input, because we have the opportunity of a platform to make those well known. And I think that in terms of the good governance report, there is some great work going on, but some of it is likely to require further resource from us as a pension fund, and that's true of all LGPS funds up and down the country. So again, we need to be conscious of that. And maybe with your consent, Chairman, I could work further with Aidan Dunn and David Wilkes, together with Karen, on some of those pieces coming forward to us, so that we are properly prepared and adequately resourced. But thank you to the team for the work they've undertaken, Chairman.
Great. Well, thank you very much for your offer to work with the officers. I'm sure they really appreciate that. Karen, did you want to reply to anything that John said?
Yes, I do appreciate everything that John has said, and would actually really welcome a conversation with John. That would be really helpful with his additional insight into the work of the Scheme Advisory Board. I think that would be excellent. And obviously, John, if you would ever be able to join the pension board meetings, I'm sure that would be very valuable to us as well. So yes, John, I'll perhaps be in contact with you if that's okay. That would be very useful.
Very happy to help, Chairman.
Thank you very much. Peter.
Thank you, Chair. Can I echo my praise for Karen? And I hate to do this, but I'd just like to modify a couple of things that Karen have said in the light of information that I've got that Karen may not have got. The first thing is that Karen implied that the 95k cap change of heart had no effect on Dorset Council. That's actually not true. It did. We had to delay a decision. I'm not going to go into detail because that would identify the individual, but it did cause significant problems. And I agree with John, I'm not going to be too critical, but I'm going to be critical. And it has caused us major issues in terms of a number of areas that we've been dealing with. So it's not been cost-free, and it's not been time-free, and it's not been irritation-free. The second thing is that myself and the leader have fortnightly, used to be weekly meetings with our MPs. And about 6 weeks ago, I told the MPs that the current situation on the 95k pay cap was an absolute dog's breakfast. It would lead us to having to break the law or having to do something that was contradictory, as well as the fact that there were a variety of judicial reviews going on, one by the First Division Association, who have a record of not losing the judicial reviews that they embark upon, and also being able to fund them. I gave the MPs a detailed breakdown of this, and I claim no credit, but it was scrapped a week later. Great. We've since discussed it with the MPs, and I have to say the mood music that we get from the MPs is that this ain't coming back for a very, very long time, if at all. So I take John's point. I think there is a judicial review and a variety of other things, and I think the government have realised that this is a nest of vipers, and they've got rather too many other nest of vipers to deal with, and there's no point in causing trouble when you don't need to, and you can deal with it elsewhere. So I certainly, we shouldn't think it's gone away permanently, but I don't think it's coming back anytime soon. Thank you, Chairman.
Thank you. Karen, did you want to add anything to that?
Yes, only that, what I meant was we've not had anybody that breached the cap that retired. Certainly from the team's point of view, it caused complete havoc and a huge amount of work. We spent, I can't tell you how many hours the team spent working with this, how many hours I spent working with employers, meeting with HR staff, meeting with individuals who were impacted, because there's workplace reform going on in both Dorset Council and BCP. So I spent a huge amount of time talking to members who were upset and confused and worried, HR staff who were struggling to know what to do, and employers. So the impact to us was just huge in terms of time and resource. But fortunately, what we didn't have was anybody actually go and be caught by the exit cap, because then we would be in a situation where we might have to unpick that. We didn't have employers making any cash alternative payments, for example, under those regulations, which some authorities are having to address. So yeah, it's all been a complete nuisance, to say the very least, and we will dread its return. I would say.
Thank you. Okay, Adrian.
Take myself off mute. I'd like to echo those comments as well, Karen. Thank you very much for a very good and informative report.
Thank you.
I'm concerned by the proposals by the SIB, not in as much as I think that they're not worthy. I think they are very worthy, but I can see that they will bring about a number of changes for us here for the LGPS. I welcome that sufficient funding will have to be put into place to mark all the measures that we're going to have to do, but clearly there are a lot of options for us. I note that you say that there's going to be some further proposals coming through from government with regard to how we put this through, but I am concerned that if we're going to have a senior officer, whether we're going to go down the route of a Section 1.5 officer to fulfil that, or quite which role. There are a number of possibilities put forward in the report. So will we be devoting some time to consider these? And will that be once we've had the MCL recommendations?
I think we need to wait for the MHCLG recommendations to come through, and then we will need to obviously, get together with the local pension board, because this will, equally impact them,
Yes.
and work together to look at, a lot of these things we do and some we don't. So we need a joined up approach to make sure that we cover everything. So some of the things we're already looking at to make sure that we can tick some boxes where we can, and then look at what we need to do going forward. So I think we'll wait for that to come through and
Yes.
go from there. Yeah.
Good.
Okay.
Thank you.
Thank you.
Aidan.
Yeah, thank you, Chair, and good morning, colleagues. I'm Aidan Dunn. I'm the Section 151 officer for Dorset Council, and thus the accountable officer for the pension fund here. Just to sort of follow on from Karen's comments and connect into what Councillor Beasley was saying earlier as well. I think as a pension committee, we pride ourselves on good governance, and I'm looking forward to agenda item 8, which looks at our governance review, and I think some heartening messages in there. I'm wondering if there's a bit of a task and finish group that we as officers, perhaps with Councillor Beasley's sponsorship, take away the recommendations from the good governance review, do a quick stock take of where we are against them, what the likely costs and implications of implementing them. That'll help inform John. I think there might be some good things that come out of this that we can continue to enhance our governance, even if MHCLG don't accept any of the recommendations at all. But I'm just wondering that I think there's probably a really useful task and finish group here that we could report back to the committee at a future date. Even that might be ahead of what MHCLG is recommending as well. Just a suggestion.
Thank you, Aidan. I think that's a very helpful suggestion, actually, and I'm sure we'll be happy to take up that offer. And Councillor Beasley, you're happy to do that as well, presumably?
Yes, I am. I think it's an excellent suggestion, because to stock take does mean that we know where we are in this process, what it's going to cost, and so on. Just to put this onto, if you like, a level playing field, one of the key drivers to the good governance review is to get uniformity across the LGPS, and that uniformity doesn't exist at the moment. My suspicion, strong suspicion, is that we perform in at least the upper quartile, but obviously there are a lot of funds where there are shortcomings which need to be rectified, and I think certainly the Scheme Advisory Board, working with MHCLG, are intent on finding common ground so that we don't make this too onerous, but we do actually have transparency over governance and consistency across the LGPS. And I welcome Aidan Dunn's suggestion, and I'm very happy to take part.
Excellent, good, thank you. David Brown.
Thank you, Chair. Actually, onto a different subject that was in Karen's report about section 12 in the report about systems implementation, about the system procurement. I just wanted to ask, whenever I read about sort of new systems implementations and the risks involved, it always it starts to cause concerns, because I'm sure we've all experienced where things have gone wrong in the past. I know what it says in the report that to date progress is as planned, and there's project monthly project board meetings, which includes 2 local pension board members. It's just whether, as the pension fund committee, there's any value in us having sort of further insight into that to ensure that we're sort of fully aware. It talks about is it monthly highlight report monitoring the project progress. I don't know whether that would be useful to be shared with pension fund committee members, or any further insight and information, just so that we're sort of aware of the progress that's being made, because there's obviously quite a lot of risks involved there if problems are encountered.
Sure. Did anyone want to comment on that?
Sorry, Chair, did you say Aidan? Yeah, sorry. There is a level of yes, I think the committee would probably benefit from that. I think as part of sort of confidence and assurance, as Karen said, we've got 2 members of the pension board that are sat on the steering group, giving a degree of assurance. But ultimately, it's a significant risk for us, as any systems implementation. So we could provide, perhaps Karen could just provide in her future report sort of a level, an update. Although I appreciate the timing of that, we're moving quite quickly now, Karen, aren't we? So maybe sort of by circulation outside of the committee, a sort of a regular stock take, if that would be helpful.
Yes, I can circulate both the RAID log, which is got the risks, which is quite a key. That's basically a risk register, the RAID log, and the highlight report, which will monitor the key sort of milestones. So those are the 2 key documents, but it is, you're quite right, Aidan, it's moving quickly all the time, and we're sort of meeting several times a week. Things are happening every day, so I can circulate that either to a couple of committee members, if a couple of committee members want to keep an eye on it, or all of the committee. I'd probably want it for commercial reasons not made public. But I'm more than happy to share those. Those are the 2 really essential project documents. Okay.
I think it probably would be better if it did go to all the members of the committee. I think particularly all the members that would be interested in this subject, and it's very important. So keeping it all updated is probably the best approach.
Yep, no problem.
Great, thank you very much. Right, I think that's pretty much finished our discussions on this. On your agenda papers, there's a slight error in the recommendations, which talks about an appendix 3, and there is no appendix 3. So basically, what we're actually suggesting is that the recommendation is just that the committee notes the report and has commented on the report, and we'll follow up all the actions that we've agreed.
Okay.
So is everybody happy with that? Thank you.
Agreed.
Very much. Thank you. In which case we go on to item 7. David Vickers has been appointed as the Chief Investment Officer of Brunel since our last meeting, and thought it would be a good idea for him to come along and introduce himself and to talk through what he's doing and the reporting that's going on at Brunel, and keep us all up to date. I can't actually see you, David, so I presume you are there somewhere.
I am indeed. Apologies and welcome. I've just found out a tree has fallen down outside of my house onto my power line. So but my phone is up and running. So hopefully you can hear me.
Yes, we can hear you. Is anybody able to share the report online so that we can all see it?
Yes, I'm hoping Catherine Dix is online, who should be able to do just that.
Yes, I'll share it now. Just 1 moment.
Okay.
Did you want to start your introduction, David, and then I'll get that?
Yes, please. Yes. So maybe it's not a bad thing. My wife always tells me I have a face for radio, so maybe this is better. Well, thank you for having me. Firstly, if I just give you a very brief bit of background on myself, so I can try and establish some credibility, so that the next while I talk, you can take it in. So I joined 9 weeks ago as the Chief Investment Officer at Brunel. I joined from Russell Investments, which is a $260 billion organization, where I was heading up the European and Middle Eastern multi-asset team. So I was really a portfolio manager as well as managing a team. and I managed somewhere in between 10 or 20 billion, depending on quite how you sliced and diced it. Always for pension funds, sovereign wealth funds, and some insurance funds as well. Prior to that, I was a partner at Saracen Partners, and for any of you who may know, Saracen is a big charity and endowment asset management firm where I looked after colleges, hospitals, and the very large endowment programs that are here in the UK and elsewhere. And then really my formative years were spent at Barings. But relatively uniquely, I've always been a multi-asset fund manager. So over the last 22 years, that's where I started, and that's where I still find myself today. And so despite being CIO here, I would like to think I'm reasonably qualified to talk to you about all the asset classes you have today and may have in the future, and drive the investment effort at Brunel, that the organisation that you have all created, to continue to put forward some pretty good numbers that I see already coming through the funds you're invested in. I'll pause there in case there are any questions about myself before I move on to the report.
Okay. Anybody? In which case, if you want to just move on to the report.
Of course, yes. Now, it's quite a long report, as you can see, and I will focus on the most salient parts, certainly as it relates, obviously, to your investments with Brunel. I mean, at the end of Q4, the end of December, you had close to 50% actually transitioned over. And I think that has moved up a little bit this year with your recent transition, close to 55%. So quite a chunk. And so thank you for the trust in the organisation you've created. But I think as this continues to go up more and more, I'd like to come to your committees to obviously explain the lion's share of where your capital is being invested.
Yeah.
If I start with perhaps the executive summary on page 4, Catherine, if you could go to page 4. If there's one page to read, it's clearly this. This is the headline, and a strong start, really at the portfolio level. So not just Brunel, but right at the top level here. A strong start at every level, total portfolio, and as you can see in the comments on Brunel's fund performance. But it's really that fund performance, i.e. the Brunel funds, that I intend to dig into. But first, I thought it very worth setting the scene as to what happened in October, November, December last year, because that really goes to why the results are as they are, and helps kind of provide some context, both for what happened, but what is happening today and what will arguably happen going forward. So you have that running theme of not just what the results are, but why they are as they were. And there's a number of pages that are written down here, but I'll surmise very, very briefly, because there obviously were a very few big events in Q4. The first one is now known as Vaccine Day, which is when the first of the vaccines got approved in the UK, the first country actually to approve Pfizer. On that day alone, equity markets finished up somewhere between 5 and 8%, depending on what markets you were invested in, and really spurred the rally that we then saw across all asset classes, largely speaking, across those last 3 months of the year. We had the US election as well. Let's not forget that. Donald Trump's swan song, which was quite a spectacle. But I think more importantly for markets, it was the fact that President Biden won, and also that he won both houses subsequently, which meant the $1.9 trillion he's planning to put into the US economy has been approved. Without both houses, that was looking less and less likely. Now, why that's important is that is 1.9 trillion on top of the 900 billion that was already put into place at the back end of last year. So that is an awful lot of stimulus coursing through the US economy. And then finally, obviously more particular to us, we had some degree of closure on Brexit, although obviously we note that the disagreements between us and our European cousins rumble on, but we did at least climb over another hurdle. So there is some certainty now to people who invest in the UK, because one of the reasons that the UK market has been such a laggard for the last number of years is that our cousins across the Atlantic, whilst they like our market because it's cheap, they didn't like the fact that every time they put money here, they lost on their exchange rate, because sterling obviously kept going down and down and down. what's happened now with Brexit is it's really put a line to a certain extent under the weakness in sterling. So foreign investors can again come back to our markets, relatively safe in the knowledge that the stocks are cheap, but that they shouldn't lose their shirt in currency, as clearly they have done for the last 3 years. When sterling against the dollar at one stage was 117, we troughed at 110. So quite an aggressive fall to take. So we will expect to see more money flowing back into the UK, which meant the UK was one of the better performing markets. The other very big trend, and you'll probably be aware of this, is that last year, for lots of reasons, was extraordinary. I think if I'd have been talking to you this time last year and I had said that we were going to have a global pandemic in which we would all be sent home, that businesses would be shut, schools would be shut, and yet at the end of the year, your equity portfolios and largely every asset class would be up in value, I think I would have lost credibility very, very shortly and very quickly. But that is indeed what happens. However, underneath the covers, actually, it was a very aggressively disparate market in that by the end of the year, 5 stocks had accounted for 50% of all global equity returns. And those 5 stocks were the FANG stocks, so-called, the Facebooks, the Apples, the Netflix, the Amazons, and the Googles. And, you know, I can't help but notice, since I've been at home, the amount of times the Amazon driver knocks on my door, and I'm sure I'm not alone in that. Those businesses, which were already flourishing, got supercharged through the pandemic, as did the likes of Tesla, which at one stage was up over 700%. And so it was a very aggressively driven stock market, but very, very narrow in its leadership, which is pretty unhealthy. When the vaccine got announced, we had what is now being called a kind of a back to work rally, where all of those unloved cyclical stocks started, that had been languishing really for 3 years, quite frankly, started to move up. And so you had a bounce in what is called the value part of the market, as opposed to the growth part of the market, which is more the tech stocks that we just discussed. And that was a huge reversal, which is probably 5 years in the making. So actually, lots of your cyclical stocks in your portfolio have now started to perform, particularly, and it was interesting, I was listening in on the comments that were being made, the questions that were being asked, but particularly the energy and the banking stocks, which had been languishing for quite some time, have started to have a bit of a reversal. The other thing that has happened, just to set the scene a little bit, is that government bond yields have gone up, i.e. prices of government bonds have gone down, which is clearly very good for your liability profile, because your liabilities are measured by the discount rate. So that's a positive fact as well. So that was the backdrop, an extraordinary year socially and an extraordinary year politically, but also in financial markets. So perhaps if I turn to, I think maybe just touch on the responsible investment part on page 10, Catherine, if you wouldn't mind. And I just want to pick up on one of the comments that was made earlier, and that is alongside your investment with Brunel and the kind of investment performance, as I'm sure you're aware, we do an awful lot, and always have done before it was popular, in ESG, sustainability, and engagement. And there are 2 things that happened yesterday, actually. You'll see on the page there's some comments about HSBC. HSBC are, or were, or probably still are actually, the 10th biggest financier of oil and gas and energy companies. And it goes to really the conversation on disinvestment. You can disinvest from BP, but someone else will buy your shares. And whilst they're still being supported financially by the banks, actually business will go on as usual. A very good kind of point of attack and engagement is actually via the banks, because if you can ask the banks to stop financing, then actually you've got another prong by which you can engage the oil and gas companies. And that's precisely what Brunel, amongst other investors, did last year. And what came out this morning is that HSBC are now proposing to put into place a plan to take themselves to net zero and themselves to stop financing, particularly coal companies, but ultimately energy companies in the future as they move forward. Now, clearly, they can't do that overnight because they have loans out and it would be litigious to pull them back. But they have now pledged to come up with a proposal to get themselves to net zero. And again, you probably saw in the press yesterday that the IIGCC framework, which is the International Investors Group on Climate Change, announced their net zero framework. And Faith Ward, who is our responsible or sustainable head, is the chair of that group. And that represents something like $20-odd trillion of assets. Lots of people have signed up, have adapted and pledged to go to net zero. And this is the culmination of engagement. And one of the reasons I actually came to Brunel was both the will of the underlying partners, such as yourself, but actually also the will of Brunel on your behalf to really push this path quite hard. And Brunel and Faith in particular are kind of leaders in this field, along with the church. And it was super attractive to me because I think we can do two things. We can continue to drive performance in the right direction and invest for a better world. The two can exist together, in fact, do exist together. And I thought that was just an interesting point to note, the HSBC one, because it's not just about the energy companies, it's about the ecosystem and the support functionality they have. So just to update you on what we're doing there, but also clearly on the pledge that Brunel has made to be net zero as well. And that 7% reduction that's going through our active portfolios every year will get us there in a good fashion. What you'll see as we talk through the funds is you'll also see the metrics on our weighted average carbon exposure. And you'll see this is also much lower than the benchmark. The only places where it is not clearly is in the passive space. In the passive space where you're tracking an index, you're going to pick up exactly what the index has. And when we think about the UK with large positions in BP and Shell and the like, actually, that's where at the minute there is not much work to be done. But even there, what we are doing is we are engaging with the index providers, and again, this is a Brunel-led initiative, actually, again, with the church, to make them think about and perhaps develop ESG-tilted indices that lean away from fossil fuels and are Paris-aligned. So again, at some stage, there will be another option if you want to be passive, which is completely understandable. You can do so, but also do so in a Paris-aligned manner. So I'll just pause there on RI in case there are any questions before we move on to the portfolios more specifically.
On the general state of the macroeconomy, I mean, it seems to me that the world central banks and the governments are effectively underwriting the market and saying, you know, that it can't be allowed to go down. It's a huge flag to investors to just pile in because it's exactly no matter what happens, the stock markets are going to go up. I mean, do you see a long-term problem with this and where this might go wrong?
I definitely do. It's what's known as the moral hazard. If you always think someone is going to bail you out, you act as if the risk doesn't exist, and you act as if there is no consequences to your actions. And so I've been doing this for 22 years. And when I started out, companies were allowed to go bust. And obviously, some companies still do go bust. But really, since the global financial crisis, the central banks have stepped in time and time again. Now, what we will never know is what would have happened if they didn't step in. You know, I can only imagine at the minute if the government in the UK and elsewhere hadn't stepped in to support, financially those people who are having employment difficulties because of the pandemic, we would have been in a very difficult social situation, which would have led to some pretty significant consequences. But nonetheless, when I think about the global financial crisis and just the fact that actually even up until last year, before the pandemic, the government was still buying bonds to support the economy, arguably. So we are a patient that has not yet fully moved out of the medication that was supplied to it during the global financial crisis. And I do think it builds up a moral hazard. And I do think it creates the wrong behaviors in investors. Because if you always think that someone's going to ride to your rescue, actually you can ride through these downs and ups quite quickly. So you tend to stretch more than you should do. Ultimately, though, however, it has to come home to roost, because what's happened, and this is very unusual. I mean, we had, with the pandemic, we had one of the biggest recessions ever on record in the UK, the biggest one since the Great Depression of the 30s. Very aggressive, very, very quick. However, when I look at valuations today, valuations in most instruments are at the expensive end. Now, usually, a la 2009, valuations were cheap, and therefore you had a very big runway of really nice returns that I'm sure you've enjoyed over the last 10 or so years. Today, when we look at asset prices, they're expensive. And expensive asset prices in of themselves create risk. because if you're higher up that ladder when you fall, you're going to cause yourself more damage. The other point to note is that there's been so much debt issued. Something like $12 trillion worth of government debt was issued last year, and $8 trillion of corporate debt. So unless we were able to burn that debt off and we have a wonderful benign environment for the next 5 or 6 years, companies are much more leveraged today than they ever were. So when and if the next wobble happens, or next crisis, whatever it might be, companies are going to be in a worse position than they were, and it will force harder consequences on investors. So I do think we should mind our eye, because the big question for me is how on earth do central banks stop buying government bonds when the market is so conditioned to it? And if inflation gets out of control, and we haven't seen inflation for 15 or so years, if it starts to get out of control, they will have to raise interest rates, which will upset the whole apple cart. So it definitely is a risk to think about going forward.
Yeah, certainly. Howard, you've got a question.
Yes, thank you, Chair. I wanted to just have a bit more information about that, almost that very last statement in the presentation about the possibility of passive investments being linked to the Paris Accord. Can we have a sort of a timeline of expectation on that?
I don't know about a timeline, but so we are, and this is a Brunel thing, but Brunel is leading the industry here rather because of our work in responsible investing. So we are engaging with in fact, MSCI and the FTSE Russell to get them to develop something that is Paris aligned. So we're pushing on them with all the power that comes with your assets and the wider kind of community to get them to create something. But they have to not only create something, but they have to show investors what the difference is, what the risks could be between a normal benchmark and a Paris aligned benchmark. Because clearly, if we get an oil price rise, which is what we're getting today, that those Paris aligned benchmarks are arguably going to lag in the short term. So it's ongoing work. We are breaking new ground really for the industry, much like we did with the Paris Accord work, because we have a seat at the right table with Faith and her team. So there isn't a timeline, but we internally have commissioned somebody for 6 months to work with the providers in order to get to a point at which we may be able to take things forward. So I will continue to update you on that work, but we are trying to drive the industry here, not just ourselves. And obviously, driving industry is a little like herding cats at some stage. I mean, it's taken us goodness knows how long. Faith's been, working in the sustainable world for 25 years, and yesterday she said this is the proudest moment of her life, that finally she's got engagement of a lot of asset owners, and everyone is finally coming on board. Now, this work won't take 20 years because the pace of change is very quick nowadays. But internally, at least, we've got a 6-month project to engage to see where we get to and see if we can force them to do something a little differently.
Okay, thank you. John.
Thank you very much, Chairman. I, as you know, sit on the Brunel Oversight Board representing Dorset, and I have to say that David is a very, very welcome new recruit to Brunel, and I think we're all quite excited about the difference that he is going to be making for us. In terms of what we've heard this morning, about the way forward for us in terms of investment vehicles and investment strategy, and bearing in mind the questions that we had at the beginning of this meeting, I'm very strongly minded that we need to get this message out more in the future, because Brunel is a leader and has been from the very start in the fields of responsible investment. The stewardship review, if you haven't looked at it in detail as members, I recommend it to you, because there's some really groundbreaking work going on. And of course, the sub-funds for renewable energy and sustainable infrastructure are funds that we are buying into and are very, very well positioned for the future. So I think my question back to David is, how can we get this message across more strongly as leaders in the LGPS pension pool field, and really make sure that people understand the work that people like Faith is doing to make us at the forefront of this change in direction for pension funds generally. Because if we can do that, then we've got a shared message with those who would otherwise criticise us And I think it would send a clear message out that will demonstrate that Dorset and the other Brunel funds are at the cutting edge of the modern way to invest.
Yes, I mean, there's a number of things that are happening. I think finally the work of people everywhere who work in the sustainable sphere is coming into the light. That, you know, for quite a long while they've been in the backwaters and not had the headlines. But because of what's happened during COVID, I think it has supercharged the efforts here. But also, I think as a younger generation come through who are much more interested and attracted to this type of proposition, again, the social media content is increasing. And we have, for what it's worth, we've recently hired someone as a communications expert internally, who will be making sure that the good work we do obviously goes back to yourselves and your members in the right format, but also goes out into the wider sphere. So people will understand without you having to knock on their doors the work that is being undertaken with you and on your behalf. And so I don't know how your local press looks this morning, but there was a lot of pickup yesterday on the IIGCC net zero announcement. And we particularly asked the news outlets to focus on the local press and to focus on yourselves and your members as opposed to Brunel, because Brunel sometimes to the outside world looks like an external asset management company. Okay, technically we are, but we're your asset management. You know, we are an extension of you. We're not commercial in the way that Schroders or BlackRock are. So we're deliberately trying to skew the message such that people understand what you are doing. And amongst other things, Faith and I are now being invited to more and more seminars to speak about these issues. So the message will be getting out. I'm speaking at the PLSA later on. Faith is very happy to speak to, and has indeed spoken to, you know, some of the more pressure groups. So I know she's spoken to a group at Oxford recently who wants everything to be divested and has, I think, convinced them that actually divestment in of itself isn't the right way forward because it won't achieve anything. That said, there are some, we don't have coal in any of our portfolios because you can't change coal companies. You can change energy companies, and actually energy companies arguably have the pockets to be the solution providers for the future. And so BP at some stage might be a very renewable only business, and they are adjusting accordingly. But there are certain companies that are just never going to get there. So we are trying to pick up the communications around this. We are trying to address, particularly if there's any pressure groups in your local area who are asking the right questions, but asking questions nonetheless. And we're trying to engage with the communities as well as with the broader press to get this message out on your behalf.
Thank you very much. David, did you want to carry on with the individual funds?
Okay, so if we can go to page 18, Catherine, and we'll just start with the Brunel portfolio overview. And there's two things to note before we go into the specifics. If you can cast your eyes to the the fourth column over, which says performance or PERF 3 months, and just cast your eyes all the way down those, you'll see some very healthy returns. You know, returns that you wouldn't normally expect to get in a 3 month period. And that alludes to what I was talking about at the top of the meeting, in that the last quarter of the year was a very good one for all asset classes because the vaccine, Joe Biden, a bit of Brexit meant that all asset classes got a big leg up as suddenly the market started to look to a world in which maybe we'll be allowed back out of our houses and normality would resume. I mean, clearly that was before we in the UK got locked down again, but nonetheless, the vaccines have shown a way through. The other column that is very useful, we will dig into this into more detail, is the one just to the right of that says excess 3 months. So this is the returns in excess of the benchmark for the portfolios over that quarter. And you can see, broadly speaking, from top to bottom, they're positive. The only one that is slightly behind, and we'll touch on this a little later on, is the Brunel UK equity portfolio. Otherwise, obviously, the passive ones are there or thereabouts. The global high alpha one is up 1.3, emerging markets up 0.6, and the diversifying return funds up 3.4. The only one that's missing there is the sustainable equity fund, and that's because that was launched during the quarter. But we'll touch on that in a bit more detail. So those are the headline figures. Pretty strong, up great in absolute terms, which is kudos to you because you invested in the funds. And then in terms of Brunel, up relative to the benchmark, which is a happy message all round. But if I can perhaps turn to, bear with me just 1 second, I have to find what page it is because I don't. My screens are off at the minute because of my power cut. So I'm flying a little blind. If we can move past the passive portfolios, unless anyone wanted to discuss them, because the passive portfolios have just done exactly what you would expect. They have tracked the benchmark, which is the ultimate aim of passive.
Just hold on one second. Howard, did you have something you wanted to ask about that?
Thank you, Chair. I actually wanted to ask something which I thought he was coming on to and sort of seemed to gloss over, but it's the same topic, I think. It's on page 13. On page 13, there's a graph there which shows the quarterly performance since Q1 2019. That's the one, yeah, that's great. Reading into that one, taking each of the individual quarterly graphs there, every time there's a positive movement, we've done better than benchmark. And the one case where there is a negative movement, we did worse than the benchmark. I'm just wondering why it is we seem to be suffering from more of a risk factor than the benchmark is.
Okay, the first thing says I'm very sorry, I can't access that page. Catherine, is that which page are we looking at here? So it might jog my memory.
So this is the summary of pension fund performance. So
is that the entirety of the pension fund performance as opposed to the Brunel portfolios that are specific?
Yes, it is the total pension fund performance. Yes, so it does include legacy performance as well.
Okay.
Chair,
sorry,
Chair, it's David Wilkes. Could I jump in there quickly, because as Catherine rightly says, this is about the summary of the pension fund performance as a whole. It's not the Brunel activity. So I think it would be difficult for David to answer that one. Having said that, it's quite a difficult question for us to answer as well. I think it may be something that maybe we need to look at and just come back to.
Okay, Chair. I don't
later point.
A comment later on in writing. That'd be fine.
Yeah.
I mean, I can definitely give you some pointers. In that, having been a portfolio manager for a long time, what one would want to look at initially is how you are positioned relative to your strategic asset allocation, relative to your benchmark. Most people historically have been a little overweight risk assets versus their benchmark. And so when the market turns as quickly as it did, you typically are, overexposed, and then it relatively bounces back. Also, when you get a movement such as the one you had when the pandemic first came to light, in that it was such a quick flush down and up, actually what happened is in most markets there was liquidity issues. And so you get some very strange, unfundamental moves. In some instances, actually the safer stocks or the larger ones do worse because they are the ones that people can sell. So weirdly, they don't sell their small cap positions because they know there's no liquidity there. So they keep those ones and they sell the safe, stodgy ones because there's lots of liquidity. So there are those type of things that often run through the market.
Chair, it's Alan Saunders. May I just offer an explanation? I'm the independent advisor. We have 10% of our assets in what are cash benchmarked, our diversified growth and our multi-asset credit, where we benchmark ourselves against cash plus 4%. So when markets go down, we have a negative return, and that exposes that discrepancy. Brunel don't add on the 4% when they have their similar asset classes. So that would provide one explanation for underperformance in down markets. Another explanation, which is particular to our fund, is our LDI portfolio. We took a big hit in Q1 last year because of the continuing debate about RPI linkage, which I'll come on to when I talk. So I think there's a reasonable explanation. It's the way in which we measure our benchmarks for absolute return asset classes.
Thank you, Alan. Okay, David, back to you then.
Perfect. Well, if I can move you to page 30. Can I just check how long I've got? I know we were a little late starting. I don't want to run over time for you.
Probably only about another 10 minutes.
That's fine. I shall hit the main points for you then. So if I can take you to the page 31, which is the Brunel Diversifying Returns Fund. It was only launched in, this is its first full quarter in Q4. It's a fund that is designed to get you the return that is targeted, but do so in a more risk-adjusted way, much like Alan just mentioned, actually. It's a cash plus target, But what one doesn't want is to get the up and the down in a symmetric fashion with equity markets. So it has much more as much as it's possible to be, much more decorrelated returns from just broad equity risk. So over the period, it was up 3.2, so a reasonably good start. Actually, before we had that vaccine announcement, the markets were a little wobbly, and the markets at one stage did fall about 6% in that quarter from peak to trough. And pleasingly, I say pleasingly, slightly tongue-in-cheek, this portfolio then was only down a little bit over 2% during that 6% sell-off. So it showed that it does have a degree of resilience built in were we to enter, another tumultuous period. But it's a tightrope. And ultimately, to me, the performance of this will be judged on the asymmetry of returns it can generate. Because there isn't, I've yet to find in my 20 years or 20 odd years an investment that only goes up in the good and doesn't go down in the bad. It's about being able to capture more of the upside than of the downside. And indeed, two of the managers in this portfolio during that weakness and before the vaccine announcements added back to equities, and so caught that upside surprise that we saw when the vaccine announcement got put to us as an investing community. So have done thus far exactly what we would hope it to do, but it is obviously very, very early days, only 3 or 4 months in. If I can just turn you then perhaps to the emerging market fund on slide 34. And here we have obviously emerging markets, one always knows what that is. Again, you can see some big returns of 13.9%, ahead of the benchmark, 0.6 in the table there. Since inception, a little bit behind. And this maybe goes to slightly your question earlier on as well, actually, because what happened in emerging markets, 40% of the index is made up of China. It's a very unusual market, quite frankly, in that lots of Chinese companies are state-owned and are used as proxies for the government. So they get told what to do and when to do it. That meant that during COVID, even though that, if you believe Donald Trump, this originated in Wuhan, China was at the kind of forefront of the issue because of the way in which they can control their population, i.e. they locked them down in a super aggressive fashion with armed guards on the boards, they cancelled New Year, etc., etc. It meant that unlike the West, they managed to contain COVID very, very quickly, which meant their economy didn't suffer as much, which meant they were able to bounce back much more strongly. So actually China as a percentage of global returns did a lot better during the downturn. Our managers here are typically underweight China because they don't want to be at the mercy of the government directing the state-owned banks. But actually in that particular instance, being state-controlled, both at a population level but at a company level, is a good thing because they just told the companies to stop doing things that are, in order to help them in the short term, but a very undemocratic way of doing so. What has subsequently happened in Q4 is that China has gone back to being a laggard. And so when the market bounced more aggressively, China was up 5% against emerging markets, up 15%. So we are playing catch up, but as you can see on the graph on the right-hand side, we are almost there. And as we shrug off this kind of the historic part around the pandemic in China, we fully expect these portfolios to continue to perform. If I can just turn, and please interrupt at any stage if there are questions. Catherine, if I can just go to the High Alpha Fund on slide, I think it's 38. This is one of the longer running portfolios. You can see from the chart on the right-hand side, it is significantly ahead of its benchmark. And if you look at the table to the left of that, you'll see over the year, it is a 15.3% ahead of its benchmark. So up almost 30% or 28.2% in total terms. A whopper of a return, both absolute and relative. What I'll say straight out the gate is I don't expect this to continue in that magnitude. Last year was a phenomenal year for markets, and those FANG stocks that I talked about that drove all of the lion's share of the market, that is something I've never seen before, quite frankly, and is not often going to be repeated. One of our managers, Baillie Gifford, managed to ride that wave all the way up. And so they were in a sensible way, they're in the right place at the right time for what occurred in 2020. So they were up relatively about 80% to their benchmark. So of that 15%, outperformance, Baillie Gifford drove about 70% of that. What is nice is they didn't drive all of it. In fact, 4 of the 5 managers were up. And what is particularly pleasing when I looked at the fund isn't just the numbers that were strong. It said actually there are 5 managers in this fund. There is one that is a value manager that had been in the doldrums for 3 or 4 years relatively. It would have looked difficult to put into the fund because would have been easy to look at the performance and say, my goodness, they don't know what they're doing. But it was a style bet they have. They run money in a certain fashion, so buying cheap stocks that, quite frankly, hasn't worked for a very long time. It worked, as I said, very aggressively in Q4, and that manager, Harris, they're called, was up about 13% relative to its benchmark. So as the tide has turned in Q4 and slightly this year, when all of those tech stocks start to come down in value, the value bet that is placed in the portfolio via Harris has managed to capture the upside in the value factor and meant that we aren't so exposed to any one particular style winning out. And you'll find that all through our portfolios. We combine managers such that the portfolio is greater than the sum of the parts. We don't want to just be exposed to small caps or growth or value as a factor. We want to have a broad spectrum of drivers in the portfolio. So that was actually, oddly, that was what I was most pleased about when I came in and I was investigating the performance. The absolute number is a wonderful one to have and serves everyone well, but actually it was the construction of the portfolio that I was most pleased with. I will pause there because it's such an unusual return in case there are any questions. Okay, I shall move on, Catherine, if I may, to the sustainable equity part. And again, this fund wasn't kind of launched over the quarter, hence there being no performance figures, apart from right at the bottom there, you can see on slide 42. It, again, was up in absolute terms and in relative terms since its inception, up a little bit, 0.4% there. So again, a positive move. All of our funds, with the exception of the passive funds, are embedded with a deep ESG philosophy. The Global Sustainable Equity Fund has that, but it also has a mandate to invest in companies that are providing solutions to climate change. So it's at the other extent to disinvestment. It's trying to find companies that are deliberately going to be riding the wave of a world that is moving towards net zero. So it's not trying to disentangle itself from the problem, it's trying to engage with the solution. And that's a nuance, but I think it's an important point to bear in mind. This is the fund out of all of them that is going to be investing in companies that are building a better future for us and riding the wave that is it might be renewable energy, it might be technology, etc., but really investing in companies that are the way forward, as opposed to just avoiding those that are potentially the past. If there are no questions, I'll move on to the last one on the active equity front. Here you can see on the right-hand side, since inception, it is above its benchmark. So the purple line is above the blue on slide 46, but on the quarter, a little bit behind the benchmark. The main reason for that is, as I talked about, the back to work rally had oil stocks and energy stocks doing very, very well. And that's continued a little bit this year. Being kind of an ESG skewed portfolio, it is naturally underweight both the banking sector that support and finance oil companies, but also the oil majors as a whole. And so it lagged a little bit in that last kind of rip up higher in the markets. I mean, that is going to be a feature of all of our funds if oil continues to do very well. But as I think was alluded to earlier, the long-term move is away from oil as a planet, as an industry, and so one does want to start avoiding those what could become very stranded assets. But you are going to get short-term blips around the oil price. I think that is fair to say, and Q4 was one of those because it bounced so aggressively from its previous lows. But otherwise, it's ahead of its benchmark since inception and moving in the right direction. So again, I'm pretty pleased with how that one is performing. And I'll just pause there because of time, but also because that's the end of the active, kind of the active Brunel portfolio section.
Thank you. I should say for members that myself, David, and Alan had a phone conversation with David Vickers a few weeks ago, just to talk about a whole raft of issues, including one which is very dear to us, which is the way the returns are reported, and we still would like to get to a position where we can see the individual fund manager's performance easily and compare it to what the overall fund is doing as well. And you did undertake to have a look into this. But you got any?
Now, and the reports were designed around yours and the other pension funds' needs. Time has moved on, and actually, as more and more of your assets get transferred across, the amount of information I would like to provide to you has grown. And so, one of the projects I've taken on board is to look at the way both. Of course you can. Of course.
You mean you lost it from this end? Okay. Well, as far as I'm aware, we're all right from this end. I think. Touch wood. Okay. Okay. So.
If I just pick up where I was, and if that's okay. So yes, one of the projects I have undertaken that was actually already in train when I joined, but I've just pushed it on a little bit perhaps, is to ensure that the reports you are receiving give you exactly what you need in order to discharge your responsibilities and provide assurance. I mean, all this information is already in incredible depth actually produced and passed through the client officers, and so David and the like, but perhaps doesn't flow through into the reports. But one of the things I said, as I have very much on my agenda, and we've hired someone internally to do it, is to create a different looking report. And what we've done is spoken to all the pension officers to ensure we've taken their views and your views obviously into account in order to do that. So that is a wait with me, but it's a project that's very much ongoing as we speak.
Good. I mean, it's very much music to our ears. It's something we've been pushing to for several months. Does anybody else have any questions that haven't already been covered? No? In which case, thank you very much, David. It was really informative and very helpful, and I'm sure we look forward to speaking to you both on the phone and hopefully in person at future meetings.
That would be wonderful. Thank you very much.
Great, thank you.
Thank you very much.
Thank you.
Right, then on to item 8, our annual governance review from Peter.
Thank you, Chairman.
Is now exiting.
I'll just highlight some points from my report. I won't go through in detail. The overall message is that good standards are being maintained despite the COVID pandemic, which I think is an important point to make. Karen has already remarked on the working arrangements, and they are an enormous challenge, and not just for this fund, for many people. And that does expose the fund to a number of risks, which, as far as I can see, are being managed properly. And as Karen said, performance is holding up as well against the benchmarks, which is all good news in difficult circumstances. I always look through the agendas of both the committee and the local pension board to make my sort of judgments on this. And I would sum that up by saying that business is operating as usual, slight hiccup at the beginning of the pandemic, as you might expect with many meetings being deferred or cancelled. And I think that is evidence of good governance in practice, the fact that you can continue in this sort of situation. The only sort of suggestion I've made is a rather small one in paragraph 3.3 on page 114, is whether the minutes of the local pension board shouldn't be reported to the committee at each meeting as the minutes of the committee are reported to the board. It's an exchange of information in that way, which I think works quite well. Just jumping over the page to 115, I've listed a sad list of many regulations and guidance issues which are hanging around that Karen has already referred to. There's an enormous logjam in regulations and guidance at the moment, and at a time when MHCLG in particular is very short of resources. There's also mix-ups and confusions, as we saw with the 95k cap, which was a disaster in terms of governance of regulations. The only other point really I'd make out of this list is about the Pension Schemes Act.
Sorry, can I just stop you 1 second? Catherine, have you seen the sign which says the recording has stopped? I don't know if you need to look into that in case we've lost the recording ability. Catherine, can you hear me? Okay. David, I don't know if you can try and get through to Catherine and oh yeah. Have you seen the sign that says the recording has now stopped? Okay, all right, fine. Okay, all right, thank you. Peter, back to you.
No, quite all right. I hope it wasn't me. The only point I was going to pick up there is about the Pension Schemes Act, which Karen mentioned. And the only point I make there is a concern I have that the new requirements in that Act, good as they are going to be regulated by the pensions regulator. And so far, the pensions regulator has not had any influence over the investment side of the OGPS, and quite deliberately. So I'm not sure how that would work, but there is a concern that the regulator might try to influence investment process, which includes funding issues as well, as it does in the private sector. And I think that's something to keep an eye on there. We've already spoken about the good governance review, and which is another big issue which is in process at the moment. I won't go back through the detail of the good governance review, but I would say these are only proposals at the moment that require guidance. They're proposals that I recall being discussed 25 years ago. So the fundamentals are not really very much different. But what I would say is in 2008, when the last guidance was produced, it took MHCLG, as it was then, over 10 months to produce guidance from the time it produced the necessary regulations. And they had a lot more resources then. So all I'm saying is I don't think this is going to happen very quickly unless there are additional resources put in. There are also a number of issues embedded in the report which could require changes to certainly secondary, but maybe even primary legislation, which will also take some time. And a number of those are about how this might influence what I call the democratic framework in which funds are currently administered, which I think is an important part of the governance framework. But picking up points made earlier, I think it would be a good idea to start to just look at the status of Dorset against some of these recommendations. I think it stacks up pretty well, but there are new details being introduced which would need to be looked at, particularly the suggestion of independent annual review or independent reviews every 2 years. Just coming on to the last page, pensions regulator, again, another area where lots of changes are supposedly being made, which will affect compliance, the guidance and the statutory requirements. I don't think this is going to make it any simpler. I think it's going to make it more complicated. So this will be yet another area where there will be more pressure on the fund. And really just coming to my conclusions, most of which I've covered, and you wouldn't expect me to finish without some sort of cynical view on things. And that is that it seems to me there's a large number of different people with competing interests in changing the way we govern the funds, to some extent interfering and meddling. to me, this is finding processes, not necessarily which are going to benefit the members of the scheme or the employers of the scheme, except ultimately, perhaps. With a well-run scheme like Dorset, I think it would be relatively easy to introduce changes. There are schemes which aren't so well run, which Councillor Beasley referred to. I think the focus should be on getting those funds to improve rather than introducing blanket changes to try and make everybody up to a level. So I'll stop there with my cynical view. Thank you, Chairman. Take any questions.
Well, thank you, Peter, and thank you for actually was a very positive report. It does make us all feel good that we are seem to be doing the right things and operating correctly, particularly when it's been a particularly difficult year as it has been. David, I don't know if you'd like to comment on the items in 6.1 of the report, which lists a whole series of governance issues that the officers are taking on board.
Apologies, Chairman. I was just looking at Catherine's message. Right. Okay. Apologies for that. In terms of the, I think Aidan touched on this earlier in the meeting that I think what would be and the approach that Aidan suggested was that we would have a task and finish. I think was to work through these various points, and I think Councillor Beasley kindly offered to provide some kind of help or sponsorship of that. So I think that's the way we would go forward with that, Chairman.
Okay, that sounds fine. Yes, John, do you want to add anything?
Thank you, Chairman. Just 2 points really. The first is I would welcome and support the exchange of minutes reflecting the work being done by the Pensions Board coming back to us as a Pensions Committee. I think that would be a very useful thing for us to see, not least because without it, we don't actually know the conclusions of their work unless it's something quite radical. And I think it would be useful for all of us to see that. And my second point is to thank Peter very much for his report. I share his cynicism. I really do. But I'm afraid the kind of world that we live in these days, it is unlikely that that will be reversed. It would be great if we could remedy those who have the greatest shortcomings without burdening ourselves with further bureaucracy and perhaps some might argue unnecessary work. I think that train's already left the station, sadly, but through the Scheme Advisory Board, I'm always conscious of that issue and will continue to repeat the message. I'm not sure that one can do much more than that.
Sure.
But similar to what I said earlier on, Chairman, if Peter has any input he'd like to make to me to reflect the position that we are in, as far as the Scheme Advisory Board's concerned, I'm only too happy to hear that. And perhaps if you'd like that, Peter, we could have a conversation sometime about it.
I'll be happy to do that, Chairman, when there's more sort of detail coming from them.
Yeah.
Thank you.
Okay. And Peter Wharf, you wanted to have a question?
Yeah, and again, thank you to Peter, whose reports are always quite amusingly irreverent and really good. I'm very grateful. Just on the task and finish, I'm just slightly concerned that we're all agreeing something, but we're actually not taking it forward. Should we get the officers, and I'm looking at Davy Wilkes, to write what we used to call an Aunt Sally terms of reference to distribute around the members of this committee, plus Peter, so that we can try and establish what the terms of reference would be, get members to comment on it, and then get members to decide whether they want to be involved or not. And I just think the terms of reference, it's quite easy to talk about these things, but often constructing the terms of reference makes you think that it's actually slightly more tricky. And if it's a task and finish group, I'm really keen that we identify what good looks like and what the finish looks like, because too many task and finish groups are tasked but don't finish, and we need to have something that very clearly says this is how we'll know we've finished. For discussion, if you don't mind, Chair.
Those all sound eminently sensible suggestions to me. So I think that David, you better take that on board.
Yes, Chairman, Vice Chairman.
Okay. And I think also, I think people are happy for the minutes of the board to be shown to the committee as well, as Peter Scales has recommended. I think this should be very easy to do. And I do try to go to all the pension board meetings and make sure there is two-way flow of information between our two groups. But I'm sure that would help further that. Okay, well, there's no other signs of any questions or anything else. While we're on the issue of governance, and it seems it's easy to hang on here as anywhere else. David, would you mind explaining what the situation is about the current state of the audit and how very frustrating it's been for you and several other officers?
Yes, Chair. Extremely frustrating. As we were talking through the minutes, and the Vice Chairman asked for an update in terms of the annual report. As I said then, the independent auditor's review of our accounts has still not been completed, and they've still not completed the main Dorset Council audit either. Prior to Christmas, and Jim McManus and/or Aidan may want to jump in, but prior to Christmas, they basically said the pension fund audit was finished, but they couldn't produce their opinion until they'd completed the main Dorset Council report. Having not heard anything from them for several months, I think last week I had tried to get them to confirm that position, and they've come up with a question that referring to a response I gave about 5 months ago, which I now need to answer, and they've kind of indicated that there may be other outstanding issues that they still need to resolve, but they haven't, despite me asking, they haven't provided that list. So I think the frustrations I have are shared with Dorset Council finance officers in terms of completing the final audit. And clearly, we're in a position now where we're in March. We should be starting preparation for our next set of accounts. I don't know, Jim, if perhaps you wanted to add anything, or Aidan.
Yeah, happy to. Morning, members. Not add anything of any good news really, though. We continue to. I reflect Dave's conversation exactly as exactly as he's played it out. We were left with one item particularly, and now there seems to be. I don't know whether it's just a misunderstanding around the rhetoric used, but we were looking at one point previously on the pension fund audit. Now we seem to be looking at one of a number of points that need to be addressing, but we've had no response to that yet. We're due an update call early part of next week. I've had some correspondence with the external auditor this morning about how we're getting on. I think it's fair to say on the Dorset Council audit, there are a number of issues in terms of our disclosure and our valuation that are of interest, but it's quite late to be coming to some of those things, would be our shared reflection on it. So yeah, very hugely frustrating. We continue to try and work on it. I think external audit have said that they continue to look at the April audit and governance committee meeting as a meeting at which we can hopefully wrap it up. But we've kind of been here before, so I'm not massively optimistic. We could just continue to work on it, but it's unfortunate. We're effectively working on audit for 2 different years at the same time now. It's very confusing.
I think this seems to me as a non-audit specialist, but a shocking state to be in. That so late in the day, and it's still not wrapped it up, and risk going into another year, and again the whole thing's muddled up. It just seems absolutely incredibly poor. Peter Wharf, did you want to add anything as well?
Yeah, I mean, you and I discussed this at our pre-meet, and I just want to publicly say what I said at our pre-meet. It seems to me, and officers may choose to word this quite quite differently, but it seems to me that this is being extended in order to increase the fees of the organisation and to make a point. And I find that unacceptable. And my question to Jim at our pre-meet was, what can we do about it? And Jim, I don't want to put you on the spot, but you said more or less we can't do anything about it. I just find that really, really frustrating. And I would just wonder whether Jim or Aidan would like to comment on just what options are open to us, please. Thank you.
Yes, thank you. Thanks, Peter. I'm happy to comment. I think your observation is an interesting one. I probably wouldn't agree or disagree. What can we do? Well, there are a number of consultations out on the future of public sector audit at the moment. We and bodies that we work with, like the Society of County Treasurers, LGA, we have and continue to respond to those. I think it's fair to say if I was our audit partner here today, he would say he is responding to those as well to make the case for a greater level of resource going into and an understanding of the timeline within which the audit profession has to get virtually all of the public sector over the line at a particular period of time, and then so it has a huge resource requirement in a very short window of time. So there is a genuine requirement for a huge amount of resource within a short period of time, and then the rest of the year, I wouldn't quite say without anything to do, but the intensity of activity is in a very short period of time. So all of that stuff is being fed in. So I wouldn't quite say we could do nothing, but I think it's fair to say also that the audit profession itself is reflecting back some concerns around to the Financial Reporting Council and others in terms of their own regulation, which is what is it that you require us to do, and is it really relevant for local authorities? So we're kind of away from the pension fund side of things now. Is it really relevant? Because that's where an awful lot of the audit effort goes. So for example, the Dorset County issue is around valuations. To a certain extent, the taxpayer on the Clapham omnibus is entitled to ask, does it really matter to anyone how you value a school, whether you componentise it? And that's where lots of the debate and disagreement and additional work is at the moment, because that's where the FRC require it, regardless of who the auditor's client is.
Yeah. Peter, are you saying something? You're on mute.
Sorry, Jim, the question I asked yesterday and the question the Councillor Bryan is asking on the chat line is, can we not change the auditors? And the answer I seemed to get yesterday was that's actually quite difficult. I appreciate that you might want to word your answer in officer speak, but the message I got was that we can't just change them.
No, I don't think we can, because we are tied into a wider public sector procurement through the public sector auditor appointment process. I suppose, having got this far, would we want to anyway? The issue is probably no. I don't think it's an issue specifically for our auditor. There are issues for the audit profession generally. So no, we wouldn't, but we would want to be able to work better with our auditor in future. It's fair to say Dorset Council has had a number of issues as a result of coming together that it will never face again. So the old county council being disaggregated, and then the aggregation of the new councils, and a whole load of work around that. So some of it we'll never have to do again, but that's clearly not the same issue for the pension fund, which is still not over the line yet, despite its in substance not really changing in terms of governance and audit.
Aidan, did you want to add anything there?
Yeah, thanks, Chair. Just a quick sort of response to Peter as well, just to highlight that this isn't just a Dorset Council and Dorset County Pension Fund issue. All over the country, there are local authorities that are in a similar position to us, awaiting sign off of the accounts by the auditors, and we've got different audit firms supporting them as well. So in response to Peter's question, if we were to change our auditor, it wouldn't necessarily mean that we'd get a quicker response. I think, as Jim highlighted, there's sort of issues across the sector at the moment, and not just local issues for us. Okay,
thank you for that. I don't think we can take that any further today, though. But thank you for raising all those issues. I'd like to then move on to item 9, the Independent Advisors Report. So over to you, Alan.
Thank you, Chair. Good morning, everybody. Well, we had a very good overview of the macro scene from David from Brunel, so I'll try and navigate my way around so I don't repeat what he had to say. It occurs to me it's a year ago since we met physically, And then the week after, the first lockdown came down and everything changed. And so it's astonishing to record that some markets turned the year at all-time highs, like the US and emerging markets, not the UK, as you've seen, down 10% last year, whereas markets as a whole were up about 13%, the US up 17%, very narrow leadership, as we heard. What I want to focus on to begin with is the issue that's concerning markets at the moment and has produced a bit of a consolidation after that strong fourth quarter rally that David talked about. And the concern in the market now is the possible rise in the inflation numbers. And the catalyst for that is really Mr. Biden's budget, the 1.9 trillion budget coming on top of Trump's 900 billion budget. That second budget, it was passed by the Congress yesterday, is roughly equivalent to 8% of GNP. This is a colossal stimulus, in terms of old-fashioned Keynesian economics. I mean, no one ever contemplated anything quite of that order of magnitude. I think in the UK, the Chancellor's budget last week was about 3%, significant, but more conventional. So the concern, particularly in the bond markets, is this going to stoke up inflation? Yesterday, we had the US inflation numbers for February. It popped up from 1.3 to 1.7%. Markets was reassured by that. It wasn't as bad as they feared. If you look at what's happened to the bond market in the States, 10-year Treasury bonds are now 1.5%. They've risen almost 1% over the last few months. In the UK, our 20-year gilt has gone from 0.7 to 1.3%. That's a rise of over 0.5%. These are big numbers. And of course, the concern is entirely that inflation will start to increase. Now, the Fed is the key player in all this. And I've mentioned to you before that the chairman, Jerome Powell, is saying he's quite relaxed about this, and they will allow inflation to overshoot their 2% policy target, the same as we have in the UK, for a while until we catch up on the underperformance. So they will cut the market some slack, but at some stage they will move from buying bonds in spades, as we are, quantitative easing, towards a neutral policy and then start to sell bonds back again. And that's the concern of the market. David made one slight mistake when he said that this was good news for us in terms of our deficit because it will mean a higher discount rate. That isn't the way our discount rate works. So we're not sensitive to the fluctuations in gilt yields, but I'll come to that when I talk about our LDI portfolio. So in terms of the broader economic impact, the stimulus is good news. The OECD calculated it will raise the level of overall GNP worldwide by about 0.5%. That is quite significant. And obviously it will benefit the UK as well. Just to focus a bit on the UK, and as I do so, I should just remind you that the UK is now a diminishing element in our asset allocation. We have now got our UK equities down to 10%. We have UK commercial property 10%, but the UK is no longer as significant for us as it used to be. And that's in line with pension funds generally. The budget last week, the forecast budget deficit, £350 billion in this current financial year, 15% of GNP, coming down to 230 billion. Significant reduction, but still whatever, 10% of GNP. But it can be funded because at the moment, gilt rates are so low. But if gilt rates rise, and I think they came up with the calculation of 1% rise in rates would lead to £25 billion extra on the budget deficit. So we're getting into that slightly concerning territory now. The UK economy is clearly lagging all other economies. We hope for a bounce of about 5% this year, maybe 6 or 7% next year. So we will recapture our end 2019 levels by the middle of next year, whereas the rest of the world, on the OECD forecast, will do so this year. I think that's a bit on the pessimistic side. I think actually our economy could bounce back more quickly. There's pent-up consumer savings. We have the Chancellor's new incentive to business to invest. So I would hope that we'd have a better outcome than that. Certainly the unemployment perspective looks a little better than we expected earlier. So that's enough on the macro side. We no doubt we had a W-shaped recovery because this first quarter we're down 3%, but then we'll have that rally forward. And the rest of the world is doing better than us. So what about the markets? David mentioned he thought there was quite a lot of overvaluation around. Yes and no. I think if you factor out the overvaluation of the technology sector, which has corrected very savagely in this quarter, the rest of the markets don't look so hugely overpriced. A touch on the dear side, but something that markets can hold on to, I think. But we're in this consolidation phase now. We're looking for earnings to catch up. And the projections on corporate profits, in the States at least, are really quite positive. A 20% rise in corporate earnings is expected this year. What I think it will lead is to more divergence in patterns. So we might expect the US to give up leadership to the rest of the world, maybe Europe, maybe Japan, emerging markets. I think there's some catch-up potential in the UK. We would also expect, as David said, that this emphasis on growth stocks, technology stocks, may come to an end, and value stocks will have a bit of catch-up, as they do. They're very cyclical. That's where we might score with our smart beta exposure, but we'd lose out, for example, in our global active. He mentioned Baillie Gifford. They've had a terrific run. Everybody reads about them in the papers. I suspect they've had a bad first quarter. All things come to an end. In terms of bonds, clearly gilts are not the place to be now. If yields are rising, you're going to be losing money in bonds. And that brings me to our corporate bond exposure. We haven't yet migrated that across to Brunel. We are overweight against our target. So I think one conversation perhaps I should have with Dave and the chair subsequently is how we reduce that corporate bond exposure, because although spreads may improve, if the underlying gilt yield is rising, then you'll be losing money there. A quick reference to property. We won't be hearing from CBRE today. Property has been the star for us for many years, but it's now clearly in a very different environment. And we had a negative return of about 3% last year, cushioned by the high running yield on property, but probably capital values fell 5 to 10% plus in retail, maybe offices, industrial property holding up very well. It's a mixed bag. CBRE talk about a 5 to 6% total return over the next 3 to 4 years. That doesn't suggest very much in terms of recovery from capital values. We sliced our exposure a little bit, and maybe that's something we need to think about. I'm getting lots of presentations to me now, my colleagues at MJ Hudson, on all sorts of housing funds, social housing, buy-to-let, private ownership, private rental, etc. They offer something similar to the inflation plus exposure we've been getting recently from CBRE. So that might be an asset class of interest. If I summarize now with final thoughts on our asset allocation, I must first mention our LDI exposure. You recall that we reduced our inflation hedge from 40% to 30%. We were very concerned about this government consultation on a move away from RPI, where they've come out, as I said in my paper, and they've confirmed the move from RPI to CPI-H, CPI with a housing allowance, by 2030. So that's quite a long time away. But importantly, and you've expressed your concern on this, no compensation for index-linked holders for this change. So this is a very unsatisfactory outcome. It may well go to judicial review. I don't know. Insight will keep us briefed on that. But surprisingly, there hasn't been the negative reaction in the markets that we might have expected. All the sell-off in the price of RPI took place before the announcement. There was quite a rally in index-linked and RPI swaps since then. So our actual, my concern would be that not only might we lose money on our LDI portfolio, but that hasn't happened, but our leverage ratio might increase, and therefore we'd have to dedicate more capital from our cash. But in fact, our leverage ratio has improved, and the reason for that is the price of inflation has gone up for the reasons I mentioned at the start of my presentation. So for the time being, the LDI portfolio is looking fine. We've had a bit of a recovery there. Dave will talk about all the movements on our equity portfolio. Lots of changes there, but to summarize, we now have a 50% exposure, 40% in overseas equities, 10% in the UK. Big changes. We're now shifting towards small cap and increased emerging market exposure. So all that is the right place. We're making sure we retain our 50% hedge. Sterling has been strong recently, as you've heard. So the last thing we want to do is to lose out through currency movements. I think probably that is the final comment I will make, other than corporate bonds, a few other slight changes. So there may be a third phase of the transition, which I'll discuss with Dave and the chair subsequently down the track. Thank you, Chairman.
Thank you. Thank you, Alan. Any questions? No?
If not, may I make a final
statement,
which is a personal statement, as they say, I understand. I've just delivered to you my 64th quarterly report. And some of you remember the old Beatles song, When I'm 64. I thought maybe it's time for me to go, therefore. And so I've had a discussion with the chair and the officers, David, and I've suggested I offer my resignation. And by agreement, that will be in September. So I have 2 more reports to write for you. I'll get to number 66 and then I shall depart the scene. So thank you very much. I've enjoyed it enormously over the years. But the 2 more meetings for me to report to you at. Thank you, Joe.
Thank you very much, Alan. I think we've all appreciated your words of advice. I'm not quite sure how many of the 64 reports I've heard personally, but I thought they've all been interesting and informative and very, very useful from our point of view. So thank you all very much. We did discuss this at our pre-meeting yesterday, and I think what we'd like to do is have a suggestion that we have a review of our position with the way we want to go forward with the advisor. So I'm going to, in Peter's words, suggest that we have a task and finish group consisting of myself as the chair, Peter as the vice chair, and David as our lead officer. And we look into the best way forward to get independent advice in the future, and look at what we want to get out of it, how it should work, and come back with a recommendation for appointing somebody. We may want to not change anything at all, or we may want to make significant changes. I don't want to prejudge what our conclusions might be, but I think we'd just like to sort of be able to get on with finding a replacement for Alan by September. So if that's happy with everybody, Peter, did you want to add anything?
I just A, to support what you've just said, and B, to say that I believe we should use this opportunity to review how we use this function and how we move forward, and give ourselves the opportunity to do it differently if we want to, or not if we don't want to. But what I want to avoid is just continuing with what we do at the moment, because that's what we do. I think it is an opportunity to review how we operate and then come back to you, the committee, and present options. I think that's really important, so that the committee then makes the further decision. Thank you, Chair.
Thank you. Does anybody wish to ask us a question about that? No, in which case then we'll move on to item 10, the Fund Administrator's Report. David.
Thank you, Chair. Don't intend to go through this in a huge amount of detail. I'll just try and pick out a few kind of key points, and then happy to try to answer questions as best we can. So I think it's probably been trailed already, but the value of the assets at the end of December were up to just shy of 3.3 million. Sorry, 3.3 billion. We'd be in trouble if it was 3.3 million. So we have seen a massive recovery from the lows at the beginning of the year, and the reasons for that have been sort of well documented by Alan and by David Vickers so far. Less positively, we asked the actuary does a full review of our funding position, so estimating what the value of our liabilities are, i.e. the pension promises that we've made, and comparing that with the assets that we have in the fund. And the last time they did that in full detail was based on our values at the end of March 2019, and they assessed that the assets accounted for would have covered 92% of the estimated liabilities, or the net present value of those liabilities to be precise, at that point in time. We asked the actuary to give us a sort of quick, it's not a full update, but it's a quick update or a quick review of that funding position every quarter now. We never used to. It's something we introduced probably a couple of years ago, so that we can kind of get an idea of where we stand in between valuations. Now that that figure, latest figure as at the end of December, is at 85%, so it's significantly less than the 92%. The two big reasons for that is, one is the methodology that Barnett Waddingham are actually use in terms of assessing asset values, in that they take an average of the preceding six months. So when you're going through a period where markets are rising, you don't get the full benefit in quotation marks of those market rises, but equally it works the other way. So it's a methodology for kind of smoothing those movements in the funding position. And the other point would be that we're the best part of 2 years on, so the liabilities will have increased as well. What, as officers, we intend to do shortly is to meet with Barnett Waddingham and to discuss this and just think about what the position might be at the next valuation that will be done at the end of March 2022, so that we can kind of we can talk about what the what options there are for us going into that valuation, so we can start thinking about that. The other thing that I just wanted to mention, I think, is something that's in the financial implications. I am perhaps a bit of a stuck record on this, perhaps. I do apologise, but I guess it's a reminder really that the way that the LGPS benefits are funded are that it's a defined benefit scheme, so benefits that are paid out are determined by a person's age and service and salary. They're not determined by the investment returns as they would be in a defined contribution scheme, and those benefits are funded by the scheme member paying in a percentage of their pay every month, and the scheme employer paying in a percentage of their pay every month as well. And I guess the important distinction is that the scheme member percentages are determined nationally by government, and the employer contributions are determined locally by the administering authority working with its actuary. So effectively, to all intents and purposes, scheme employers bear the risk that investments don't perform at the level that we need in order to have sufficient funds to pay the benefits as they fall due. The only other points I just wanted to raise relate to the asset allocation, where we are with asset allocation. So the table under paragraph 10 at the top of page 128, I think it is. So this is the position that we were in at the end of December. So as Alan and others have mentioned already, following the review of the strategy in September, we have prior to December, we actioned the move away from UK and more towards overseas or global, specifically a first tranche of investment in the Sustainable Equities Fund. So the move away from UK to global is reflected in these figures. So we are, in terms of our actual position compared to our target allocation, we are slightly over, but we are there in total, near enough. What we've done subsequently to these figures is that we've actioned the second part of the changes. So we have now disinvested from Wellington, who are our last remaining global equities legacy manager, and those funds have been reinvested primarily in the Global Sustainable Equities Fund, but also into the Brunel's Global Smaller Companies Fund and a top-up of the Emerging Markets Fund. So at the next meeting, I'll be able to give you kind of chapter and verse in terms of that transition. We will be meeting with Brunel and the transition manager that they use, Macquarie, shortly when we have a final report in terms of the transitions, and we'll share those. So that meeting will be myself, the chair, and Alan as the independent advisor, and we'll obviously share those kind of key findings with you. what I would say personally from an officer perspective, I think the changes we've made and transitions we've made have been handled or facilitated really well by Brunel. So which has been very pleasing, and I hope that's borne out in the final report that we get and that we share with you. Just a reminder for that, for committee members perhaps who predate pooling, the kind of amount of change that we agreed in September to implement that within 6 months would have been impossible pre-pooling. We would have been measuring that in success in years, not in months. As Alan has indicated, there are a couple of areas where we still are adrift from our target allocations quite substantially, and Alan talked about corporate bonds. So we and the other main area is in the private market areas, so private equity, in it predominantly, also infrastructure. The property figure that we're showing there is showing us slightly below allocation, and part of the reason for that is, as Alan said, capital values in properties have taken a hit this year, as for reasons I think we all would understand. So I think, as Alan said, I think we need to have a conversation about that corporate bonds money, and what we do with it, and when we reduce down to our allocation. The private markets areas are notoriously hard to. It's easy to make an allocation to private markets. It's harder to actually get your money invested, and we also need to work with Brunel in that area as well, just to ensure that we've got the right levels of commitments to ensure that we can get our money invested. I would say it's not as quickly and as wisely as possible. We don't want the money invested in poor opportunities. So I think this committee's heard quite a lot over the last year or so in relation to the private markets area, and I think we would hopefully be able to spend a bit more time in future meetings, perhaps talking about private markets as well, getting to understand the options better, and how we can get our money invested in that area. I think just looking at my checklist there, I think that's probably all I wanted to say. So I'm happy to do my best to try and answer any questions that committee members may have.
Well, thank you, David. I think it's really invaluable the work you've done in getting the transfers of assets organised, and doing a huge amount of liaison work with Brunel to make it all run very smoothly and efficiently. I think what impresses me is, if you look at the performance on 12.1, is the performance in the fourth quarter last year was very strong, both in absolute terms and relative to the benchmark. And to do that while significantly reorganising the fund is a really difficult, really good achievement, and very difficult to do. There's always the risk when you are moving things around that that you will get caught by market movements and lose out on gains. But we have not only not done that, we've actually outperformed, and I think it's really good. David Brown has a question.
Thank you, Chair, and yeah, thank you, David, for that summary. Actually, when I'd looked at that table, nearly everything you said answered the queries I had about where we were underweight around private equity and infrastructure, and overweight in corporate bonds, etc., and the reason for the drop in the sort of property element because of capital values, as you mentioned. What I was really interested in, obviously, where we've shifted away from UK equities to overseas equities. And you look at the percentages, but when you look at the actual numbers there, broadly £150 million less in UK equities and broadly £500 million more in overseas equities. So it's a major shift in our portfolio. Just a question around, obviously that's partly been facilitated through the pooling, but around the sort of transaction costs of that kind of shift. Are we gonna have we had to sort of pay the price a little bit in terms of facilitating those transactions to move between those sort of classes?
Yes. Oh, sorry, Alan. Did you want to?
Well, after you, Dave.
Yeah. All right. No. So it's a very good point, and it's the easiest way to lose money is to churn your assets too frequently. So clearly, it's something that we try to avoid. We are a long-term investor. We do have this kind of triennial review of our liabilities, and we also take that opportunity to review our asset allocations as well at that same time. And you'll recall that back in September, I think the committee made a strategic decision to increase the allocation to equities full stop, and then to rebalance that between UK and global. As I said before, we're still waiting for the final report from Macquarie, who were the transition manager that Brunel used. But the figures received for the first tranche of movements before Christmas, and the indicative figures that I've seen for the second tranche that's just completed in the last few weeks, I think, compared to the overall, I don't want to quote any figures here in case I'm wrong in terms of the figure, but compared to the overall, the gross size of the transitions that we've put through, the transition costs have been kept to a very, very small amount. But it is just, as you said, it's a consequence of making changes. There will be a cost of it, and as I said, I will share that information more fully with committee members so that you can kind of see what that cost is. What we don't want to do,
when we get the
apologies, Andy.
When we get the second report through, you can just do a note on an email and send it through to members. I'm sure that would be appreciated.
Yes, I was just going to. I mean, it's a very relevant question, and the committee should take these transition costs seriously, because the whole point of pooling is that in the long run, the savings in management fees should exceed all the costs in migrating across to the Brunel pool. And of those costs, transition costs are quite a significant element. So the first phase of the transaction, when we sold the Legal and General UK passive into the new sustainable equities, I think that cost about £1 million altogether, which is somewhat ahead of target, but well within the range of uncertainty. And most of those costs are caused by impact costs when you're building up your portfolio of new stocks. There was also an anti-dilution levy from leaving Legal and General. So, and there'll be more again from selling down Wellington. I think as we leave Wellington, Chairman, we ought just to acknowledge their very good performance with us. We set them a 2% outperformance target, and they delivered on that over the 3-4 years they had the mandate. So it's with some regret we say goodbye to them, so be it. But the transition costs, I think the committee, please, after my departure, keep them under control and keep monitoring them, I would say.
Yeah, definitely. Any other questions? Okay. Well, I think also another thing we mentioned in the pre-meeting was where we want to go in terms of training over the next few months. And I'm making 4 suggestions of things where we need to do a bit more work, I think. One is to look again at the property situation, and particularly as there's so much going on the social housing side of things as well. Another is to look at the inflation hedge again, bearing in mind the change in the legislation now. Now that we know what the government's proposals are, and see if we want to make any changes based on that. Thirdly, to re-examine the smart beta, which was one of the Mercer suggestions that we didn't really spend too much time on in their report, but I think it's worth looking again at re-examining what a smart beta is and how it works, and see if it's exactly what we need. And another recommendation, we didn't have the opportunity to go anywhere with it from Mercer's, was about investigating private debt. So I think it's again something we're going to be looking at. So those 4 things, I think, over the next couple of meetings is what we want to really focus on for training. But I'm quite willing to consider anything else that members might feel would be interesting to spend a bit more time on as well. If you have any suggestions, you can either make them now or send them an email to me after the meeting if there's anything else we should be focusing on. Peter?
We also discussed, and Mark Roberts has put something in the chat line, we also discussed looking forward to going to London in September and hoping that the situation had changed such that we can avail ourselves of some expert advice and also do some socialisation. Thank you.
Certainly. I was going to mention that later on when we get to the dates, but yes, hopefully we can start developing a real plan of face-to-face training in September. Should the situation be better than it currently is. Any other points on this? If not, I'd like to ask John Beasley to give us a report on the work he's been doing with Brunel and where we are on Brunel governance matters.
Well, thank you, Chairman. I will be brief, and I suppose we've heard a great deal about Brunel during the course of this meeting. The strategic business plan has been what we've been concentrating on in the last quarter, and I suppose that what underlines that is taking stock of how we've got to the position we are and what it looks like going forward. The Brunel team are edging back to the reality of an office environment at the moment, which is to be applauded, I think, because a lot of the work that is undertaken in an office environment, I suppose, does affect not directly performance, but it is about that networking and people working together as part of a team. I suppose the underlying issue on a sort of meeting by meeting basis for the Brunel Oversight Board is about performance, because performance is absolutely key, and ultimately pooling is nothing without outperforming what we would have been doing otherwise. And it's certainly something that exercises members of the Brunel Oversight Board on a regular basis, and quite rightly too, frankly. But it is too early, I think, overall to come to a conclusion on that, because as we migrate assets over, of course, the other funds are doing likewise. Some are a bit ahead of us, and some are somewhat behind us. But nevertheless, it is something which certainly the chair of Brunel and the senior officers are perfectly aware of, and we will be looking to get a better sense of that over coming meetings, and of course they will be reported back as soon as that information is available. I don't think really there's very much to add at this stage, Chairman, particularly given the hour, but I'm happy to answer any questions, of course.
Thank you very much. Are there any questions? No? In which case, then we'll go on to item 11, the Treasury Management Strategy for 2021-22. David.
Thank you.
You again.
Yep. I should get better at planning these agendas. This is the annual Treasury Management Strategy, which comes to committee about this time every year, just before the beginning of the new financial year. It's essentially sets the parameters for managing cash, so our cash holdings and our cash flows. It's based on the Dorset Council Treasury Management Strategy, but the differences really are that the Dorset Council strategy has a lot more focus on borrowings as well as the investment side of things. The pension fund can borrow for a cash flow purpose, but and we have done in the past, but it tends to be for a matter of days. So, for example, if the payroll at the end of the month goes out and we know that there's some money coming in a few days' time, we may do short-term borrowing just to cover that. But from memory, we haven't done so for at least the last 2 years, possibly 3 years. So I can't remember when we've last done that. So basically, it's the parameters for which we manage our cash. So who we can invest it with, and how long we can invest it for. The strategy does allow us to invest the money for up to 2 years with certain counterparties, such as central government or local authorities. In practice, we've never done that, and I don't think we would ever do that. But it's there just to give us that headroom if it was ever needed. In reality, the majority of our cash now is held in money market funds, which basically after fees are probably negligible returns, but tying money up for 2 or 3 months again gives you a negligible return. So I guess the wider issue, really, for slightly out of scope of this, really is ensuring that we have got the right levels of cash to manage our normal operational of the pension fund, and that we don't have too much sat in cash. So I think coupled with the review, if you like, in terms of bonds, I think we also just need to have another look at our cash balances and see if we're holding perhaps a little bit too much now. I think you may recall this time last year we perhaps allowed our cash to build up a little bit because of the nervousness that we had about what was happening in the wider economy and markets. So I think that's all I wanted to say, Chair. As I said, happy to take questions.
Yeah. Any other questions? No. In which case, can I see a show of hands for approving the Treasury Management Strategy for next year? Everybody, yes. Thank you very much. That's approved. On then to item 12, the dates for the remaining part of the year. As has been said, the current legal position is that online meetings like this have government approval or legal approval up to May the 8th. And then we have to wait and see what they're going to propose for what happens next. Hopefully there'll be some sort of allowance to carry on meeting online for a few more months, even if we have to do it on some sort of hybrid route or something. But so therefore we can't be sure what exactly the format will be for our meeting in June. It either will be at County Hall or it may be again on Microsoft Teams, depending on what the government's advice is as we get nearer to things. But hopefully that should be the last of our meetings that are affected by this. So we are going to be going ahead with planning a full trip to London at the beginning of September. And we will be doing the usual day's training, particularly on the issues that I mentioned already. And I think we should probably investigate the current financial health of some of the pubs that we own in central London as well as part of the procedure. So if that's okay with people, that we will carry on with the dates that are being proposed there. Adrian, did you have something you wanted to say?
Yes, one of the few pieces of fallout from the pandemic that I really applaud is the ability.
Adrian, your microphone is.
Sorry. Yeah, one of the few pieces of fallout that I really applaud is the ability for us to have this sort of meeting. In that it gives much better accessibility for members of the public across the whole of Dorset to be interested in the operation of local government generally, as well as the local government pension scheme. So for myself, I'm quite happy to continue this format for a while. But yes, I do appreciate the sort of personal training that we can get when we go away.
Yes, certainly. Thank you. I mean, I think ultimately we have to be going by what the government regulations state, and certainly we would have to have a steer at some point about what the situation will be to carry on, to have the annual meetings of the various councils and to carry on through to the summer. But hopefully by the time we get to September, things will be sufficiently okay on the COVID front that we can have a very productive meeting in London and make the most of it. If that's all right, then everybody, I'd like to say a big thank you to all your efforts today. We have actually managed to finish slightly earlier than scheduled, so thank you all very much. And yes, see you later on in the year.
Well done, Andy. Thank you, Chair.
Thank you.
Thanks, everyone.